Welcome to the deep dive. This session, well, it's really laser focused on you, the financial reporting student. We're hitting those complex, high-mark technical spots that honestly make or break the ACCA FR exam.
Exactly. If you're feeling a bit swamped by all the IFRS standards, think of this as your essential guide.
We know you're past just learning the definitions.
Absolutely. Our goal today, what we call the SmartPass approach, is to go way beyond just listing rules. We want to focus on application, how things connect, and really importantly, why these standards are even there.
So what's on the agenda?
We're tackling the big ones. The
Yeah.
conceptual framework, the nuts and bolts of non-current assets, and then that challenging trio, leases, provisions, and deferred tax.
Okay.
The aim, to make sure you can confidently handle both the calculation bits and the discussion questions. That's where the top marks really are.
Right, let's get straight into it then. We're aiming to cut through the noise, find those key nuggets that really maximize your exam score. #I. The conceptual and regulatory foundation.
Okay, first up, the conceptual framework. Look, this isn't just background theory, right? It's basically the rule book, the logic behind every single standard you study.
So if you lose sight of the objective,
You lose the plot, basically. You won't understand why the standards work the way they do.
Okay, so let's ground ourselves. What is that core objective? The framework spells it out pretty clearly, doesn't it? It's about looking outwards.
It is. It's about providing financial information about the company. That's useful
Useful to who?
to the people putting money in, investors, lenders, other creditors, both current and potential. Useful for making decisions about, well, giving the company resources.
That phrase, useful in making decisions, sounds pretty central.
It's absolutely key. And what decisions are we talking about? They're fundamentally assessment decisions. Users are trying to figure out two main things.
Okay, what are they?
First, the company's prospects. Its ability to generate cash in the future. Is it going to survive? Is it profitable?
Makes sense. And the second?
Management stewardship. How well have the managers actually used the money and resources they've been given? It's about accountability.
I see. So the statement of financial position shows the resources and claims, and the profit or loss tells us how those changed. That feeds into those decisions. Investment, financing, voting.
Exactly. But the framework itself, it does more than just define things. It plays a really critical role in stopping, well, let's call it manipulation.
Creative accounting.
Precisely. The framework is like the quality control for making new standards and make sure they're developed logically, consistently.
And it helps when there isn't a specific standard.
Yes, it acts as fallback guidance for accountants if there's no specific IFRS for a weird transaction. And maybe most importantly for market integrity, to help stop creative accounting by setting principle-based rules.
Like defining assets based on substance, not just the legal paperwork.
Exactly that. It forces everyone to look past the legal form. Think about leases under IFRS 16. That's all about substance over form, right? The framework provides that foundation. #B, core qualitative characteristics, exam favorites.
Okay, so if the objective is the goal, the qualitative characteristics are like the tools to get there. You mentioned fundamental and enhancing ones.
That's right. Let's start with the absolute must-haves, the fundamental ones.
First step, relevance.
Information is relevant if it makes a difference to users' decisions. It needs predictive value or confirmatory value, or maybe both.
But it's tied to other ideas too.
Deeply linked, yes. First, the nature of the item, just what is it?
Yeah.
Second, its materiality. Now, materiality is specific to each company.
Right, it's not just a fixed percentage rule.
No, definitely not. If leaving something out or getting it wrong could reasonably influence a user's decision, then it's material. Examiners love asking about this, because it requires judgment, context.
Okay, that's relevance. What's the second fundamental one?
Faithful representation. And this is deeper than just being accurate. It's about showing the true substance of what's happening economically.
So what does that involve?
3 things are needed. Completeness, you need all the necessary info, descriptions included. Neutrality, no bias. And freedom from error.
And neutrality is supported by something called prudence.
Yes, prudence supports neutrality. It just means being cautious when you're making judgments and things are uncertain. Like, recognize losses quickly, but only recognize gains when they're pretty much certain.
This sounds like where things get a bit tricky, especially around measurement uncertainty. That causes arguments in practice, doesn't it?
Oh, absolutely. If the uncertainty in measuring something is just too high, it really undermines faithful representation.
Can you give an example?
Think about valuing really complex financial derivatives or maybe a huge long-term provision, like decommissioning a nuclear power plant decades from now. The assumptions, the variables, they're massive.
So what does the framework say then? If it's too uncertain, do we just ignore it?
Not necessarily. The revised framework acknowledged that, look, sometimes perfect faithful representation isn't possible because of this measurement uncertainty.
Yeah.
But that doesn't automatically make the info useless.
Okay.
It means the company must provide really clear disclosures about that uncertainty. Be transparent about the shaky ground. So for you as a student, the takeaway is high uncertainty means detailed disclosure, not automatically skipping recognition.
Right. Makes sense. So those are the fundamental two. What about the enhancing ones?
Once you've got relevance and faithful representation, these four help make the information even more useful.
Okay.
We've got comparability, so you can compare results period to period or company to company. Verifiability, meaning different experts looking at the same data would broadly agree. Timeliness, getting the info out quickly. And understandability.
Understandability assumes the user knows a bit about business, though, right?
Yes, assumes a reasonable business knowledge. Remember, these enhancing characteristics, they can't make bad information good. They just make good information better.
Got it. And there's one final reality check, the cost constraint.
Never, ever forget this one. Producing financial reports costs money, time, effort, systems. The benefit users get from the information, making better decisions, has to outweigh the cost of providing it. It's the ultimate practical limit.
Good point. Before we move off the framework, we should probably quickly recap the definitions of the elements themselves. Everything hangs on these.
Definitely. Asset, a present economic resource. You control it. It came from a past event. Liability, a present obligation. You'll have to transfer an economic resource. Again from a past event. Equity, what's left over the residual interest.
And income and expense.
Income, increases in assets or decreases in liabilities that boost equity, but not from owners putting money in. Expense, the opposite. Decreases in assets or increases in liabilities that reduce equity, other than distributions to owners.
These are the absolute building blocks.
They are. If something doesn't meet the definition of an asset, say, you just can't put it on the statement of financial position. Doesn't matter how important it feels commercially.
Okay, financial reporting isn't set in stone, is it? We know about the IFRS Foundation, the IASB, the Interpretations Committee, but there's a big new player students need to know about, the ISSB.
Yes, the International Sustainability Standards Board. This is a huge shift in direction. It was announced back at CUNA P26, late 2021.
And their job is?
To create a global baseline for sustainability disclosures. Why? Because investors are increasingly demanding it. They want standard, decent quality info on climate and sustainability to properly assess long-term company value and risk.
So this isn't just like greenwashing or PR. It connects back to the framework's objective, assessing prospects' cash flows.
Precisely. It's about investor utility.
Yeah.
And their first two big standards are already effective for periods starting January 1st, 2024.
Okay, what are they?
First is IFRS S1. That's the general requirements one. It basically says companies have to disclose material sustainability-related risks and opportunities.
And the key thing for FR students?
The emphasis on consistency. These sustainability disclosures have to tie in with the financial statements. The story needs to match the numbers.
Makes sense. And the second standard, S2.
IFRS S2 dives specifically into climate. It demands details on physical risks. Think rising sea levels impacting property transition risks like policy changes making old tech obsolete, and also climate-related opportunities, maybe developing green tech.
So stuff that used to be maybe in a separate voluntary report is now becoming more formalized.
Exactly, because it directly impacts company valuation and prospects. So for the exam, you need to know the ISSB exists and that its standards are aimed at giving investors material information. Hashtag take two, presentation and reporting structures. IFRS 18 and IA 7.
Okay, let's shift from the why to the how. How do we actually present all this financial information? Let's look at the core statements, particularly equity and cash flows. Hashtag A, key components in IFRS 18.
Right, a full set of financials, you need the 5 key components. Statement of financial position, SFP, statement of profit or loss, and other comprehensive income, SPLOCI, statement of changes in equity, SOCIE, cash flows, and of course the notes.
And the overriding principle is fair presentation. How's that achieved?
Mostly it's about following the IFRS accounting standards properly. That's the main route to fair presentation.
Okay, let's zoom in on the SPLOCI. That distinction between items hitting profit or loss, PL, versus other comprehensive income, OCI, and whether they get recycled, that's still super important, right?
Absolutely vital. The recycling rule is key. Some OCI items are like holding pens for profit. Think about gains or losses on certain debt instruments held at fair value through OCI. When you sell the asset, that gain or loss often gets recycled, moved out of OCI and into PL.
But not everything gets recycled.
No. Things like revaluation gains on property, plant, and equipment under IAS 16, or some pension actuarial gains losses, they generally stay out of PL permanently. They remain in the revaluation surplus or other reserves. Even if the asset's sold, the gain might just get transferred directly to retained earnings, bypassing PL.
And IFRS 18 is aiming to make this clearer.
Yes, the goal of IFRS 18 is to try and streamline things, categorize these OCI items more logically for, hopefully, better understanding. Hashtag B, statement of changes in equity, SOCI practical application.
The SOCI often feels like the examiner's favorite place to hide tricky adjustments, doesn't it? Getting those closing reserve balances right takes real care.
It really does. And the starting point is so important, opening balances as they were previously stated.
But what if there was an error last year or a policy change?
Then you must adjust that opening retained earnings balance first, before you even touch the current year's figures. That restatement for a prior period error under IAS 8 or a change in accounting policy needs to be shown clearly. Calculate the restated opening balance, then move on.
Okay, so start with the restated opening. Add the total comprehensive income for the year, that's profit plus OCI, take out dividends paid, factor in any new shares issued. But let's focus on that classic IAS 16 adjustment, the excess depreciation transfer. That catches people out.
The classic multi-step trap. Okay, so you revalue an asset upwards, great. But now, the depreciation charge hitting your PL each year is higher than it would have been based on the old historical cost.
Right, because the carrying amount is higher.
Exactly. And that higher depreciation reduces your profit, your distributable profit. So IAS 16 allows, it's optional but common the company to make an internal transfer each year.
A transfer of what?
The excess bit of depreciation. The extra amount that only exists because of the revaluation. You transfer that amount from the non-distributable revaluation surplus reserve to the retained earnings reserve.
And why do that? What's the logic?
It basically lets the company realize that revaluation gain bit by bit in retained earnings as the asset is used up. It makes that portion of the gain available for potential distribution down the line, even though no actual cash is moved.
So if you miss that transfer in the SOCI calculations,
Your retained earnings will be too low, and your revaluation surplus will be too high. Wrong balances all around.
mechanically, what does the double entry look like within the SOCI columns?
You're looking for a debit entry in the revaluation surplus column and a credit entry in the retained earnings column for the amount of that excess depreciation. Seeing that transfer is a big signal. You understand how revaluation and depreciation interact over time. Hashtag tag C. Statement of cash flows, IAS 7. Operating activities focus. Okay, IAS 7. Statement of cash flows. Given exam pressures, the absolute focus has to be on the indirect method for operating activities. It's purely a reconciliation exercise.
Right, converting accrual profit back to cash flow from operations. Where do we start the reconciliation, and what trips students up here?
Typically, you start with operating profit, or PBIT, profit before interest and tax. The common mistake is starting with profit before tax.
Why is that wrong?
Because profit before tax already includes finance costs and maybe investment income. Those cash flows belong in the financing and investing sections of the statement, not operating. Starting with operating profit isolates the cash generated purely from the core day-to-day business before financing and tax kicks in.
Okay, start with operating profit. Step 1 in the reconciliation, adjust for non-cash items.
Exactly. Anything that reduced profit but didn't involve cash needs adding back. The big one is obviously depreciation and amortization. Add it back.
And things that boosted profit but weren't operating cash.
Remove them. The classic example is profit on disposal of PPE. That profit figure needs to be subtracted here because the actual cash received from selling the asset belongs down in the investing activity section. You don't want to double count.
Got it. Step 2 is the working capital adjustments. This is about movements in current assets and liabilities on the SFP.
Yes, and you need to remember the inverse relationship here. Think about it. If an asset like inventory or receivables goes up, what does that mean?
You've used cash to buy inventory or fund receivables, so cash outflow.
Exactly. An increase in those assets is a subtraction in the cash flow reconciliation. If inventory jumps $10, you use $10K cash.
And the opposite for liabilities like payables.
Right. If payables increase, you've held onto your cash longer, delayed payment. That's effectively a source of cash, a cash inflow. So an increase in payables is an addition in the reconciliation. You got a bit of free short-term finance.
Okay, that logic is clear. Now the final crucial calculation step, tax paid. We can't just pull the tax expense figure from the SPL OCI, can we?
No, absolutely not. That tax expense figure includes the movement in deferred tax from IAS 12 and the current tax charge for the year. Deferred tax is non-cash. So to find the actual cash paid to the tax authorities, you must use a T account for the current tax payable liability.
Can you walk us through setting up that T account?
Sure. It's straightforward. You start with the opening balance of the current tax payable liability. That's usually a credit balance brought forward from last year's SFP.
Okay.
Then you credit the T account with the current tax expense for the year. That's the charge calculated for the SPLOCI, the amount actually relating to this year's profits.
Got it. Opening balance, add the current year's charge.
Then you put in the closing balance of current tax payable from this year's SFP workings. That will be a debit entry needed to balance the T account at the end.
And the cash paid is?
The balancing figure on the debit side of that T account. That debit balancing figure is the cash paid for tax during the year, and that's the number you subtract as an outflow in your operating activity section. It's a standard requirement. You'll see it all the time.
All right, let's get into non-current assets. The big ticket items, tangible and intangible, that really drive the business. These are prime territory for calculation questions, starting with the workhorse. IAS 16, hashtag 8. Property, plant, and equipment, IAS 16.
Okay. Initial recognition. When you first get the asset, you capitalize it at cost. But cost is broader than just the sticker price, isn't it?
Definitely. It's the purchase price, yes, plus any non-refundable taxes, but also all those directly attributable costs.
Like what?
Things like getting the site ready, delivery, installation, testing fees, maybe architect or engineering fees. Basically anything needed to get the asset to the right location and condition so it can actually start working as management planned.
And there's one component of cost that often gets missed, especially if it's far in the future.
The dismantling costs.
Yeah.
Right.
Exactly. If the company has an obligation, legal or constructive, to dismantle the asset, remove it, and restore the site at the end of its life, you have to estimate that future cost and include its present value, PV, as part of the asset's initial cost.
And that creates a liability, too.
Yes, at the same time, you recognize a corresponding provision under IAS 37. And then year by year, you'll have a finance cost as you unwind the discount on that provision. It's a common link between standards.
Okay, that's initial cost. What about later on? If a company chooses the revaluation model instead of the cost model, what are the rules they have to stick to?
Two really critical disciplines here. First, revaluations need to be done often enough with sufficient regularity, is the phrase. So the carrying amount on the SFP isn't materially different from the actual fair value at the reporting date. You can't just revalue once and forget about it for 10 years if values are changing.
And the second rule?
Consistency across the class of asset. If you decide to revalue your office buildings, you have to revalue all your office buildings in that class. You can't cherry pick just the ones that have gone up in value.
Right. Now, depreciation. Often it's not just one calculation for a big asset. We have component depreciation. Can you explain that? What are the practical issues?
IFRS says if an asset is complex, made up of significant parts with different useful lives, you have to break down the total cost into those components and depreciate each one separately over its own life.
The classic example is an aircraft.
Perfect example. You might have the main airframe with a life of, say, 30 years. Then the engines might only last 10 years before needing major overhaul or replacement. And the interior fitting seats, galleys, maybe only 5 or 7 years.
The challenges.
Justifying those splits and the separate lives. Management can't just use one average rate for the whole plane because that wouldn't accurately reflect how the different bits are being used up. It wouldn't be a faithful representation of the asset's consumption over time.
So auditors would want to see good evidence for those different lives.
Absolutely. Evidence that the parts are genuinely distinct and have different wear patterns. It forces a more detailed look than just the total cost and ensures the depreciation hitting PL better reflects the economic reality, especially for those high-value, shorter-life components. Hashtag B, intangible assets, IAS 38.
Okay, moving from the physical to the non-physical. Intangible assets under IAS 38, often invisible on the factory floor, but potentially hugely valuable. What makes something an intangible asset?
3 key defining characteristics must all be met. First, identifiability. This means it's either separable, you could sell it or license it separately, or it arises from contractual or legal rights.
Second.
Control.
Yeah.
The company has the power to get the future economic benefits from the asset and can restrict others' access to those benefits.
And third.
The existence of future economic benefits, like increased revenue or cost savings. If an item fails on any of these three, you just expense the cost.
Right. Now, probably the biggest technical challenge in IAS 38 and almost guaranteed exam territory, the split between research and development, R&D.
This is absolutely critical. It tests your understanding of the definitions and your calculation skills. Let's start with research.
What's the rule for research costs?
Simple. Always expensed immediately to PL. No exceptions.
Why?
Because it's too early, too uncertain. Research is defined as original, planned investigation aimed at getting new scientific or technical knowledge. You don't know yet if it will lead anywhere commercially viable.
Okay, so research expense. What about development?
Development is different. It's the application of research findings to plan or design new or substantially improved materials, products, processes, systems, etc., before commercial production starts. Development costs can often be capitalized as an intangible asset, but only if the company can demonstrate that it meets all 6 specific criteria.
Ah, yes, the 6 criteria. These are vital for any R&D question. Can you list them?
Okay, here they are. You need to show. 1, technical feasibility. It's actually possible to finish the project. 2, intention. You genuinely intend to complete it and then either use it internally or sell it. 3, ability. You have the capability to use or sell the resulting asset. 4, resources. You have adequate technical, financial, and other resources available to finish it. 5, benefits. It's probable that it will generate future economic benefits. 6, reliable measurement. You can reliably measure the costs incurred during development.
All 6 must be met.
Every single one. If even one isn't met, you have to expense the development costs.
What happens if, say, a company is developing something, meeting all 6 criteria, capitalizing costs, but then runs out of money, so it fails the resources available test?
Good question. From the moment it fails that criterion, any further spending must be expensed to PL. If later on, maybe they secure new funding and meet all 6 criteria again, they can start capitalizing new costs from that point forward. But crucially, the costs that were previously expensed cannot be reinstated as an asset.
Right, that's a harsh rule, but ensures only viable projects get capitalized.
Exactly. It's a high hurdle.
This also helps explain why you generally can't capitalize internally generated brands or mastheads or customer lists, right?
Precisely. It links back to faithful representation and reliable measurement. How could you possibly separate out the specific costs of building your company's brand reputation from the general costs of running the business, advertising, marketing, etc.?
It's all mixed together.
It is. Because the cost can't be reliably identified and measured separately, you can't recognize it as a distinct asset. You can recognize a brand or customer list if you buy it from someone else, because then you have a transaction price, a verifiable cost, but not one you grew yourself.
Okay, one last point on IS 38, revaluation. Can you revalue intangibles like you can PPE?
You can, but it's much, much rarer. The rule is you can only use the revaluation model for an intangible asset if there's an active market for that specific type of asset.
And active markets are uncommon for intangibles.
Very uncommon. Think about unique software or a patented formula. There's no regular market of buyers and sellers for identical items. You might find an active market for things like, say, taxi licenses in some cities, or maybe fishing quotas, or some freely traded emission permits. But for most internally developed or acquired unique intangibles, no active market exists, so you're stuck with the cost model. #tag C, impairment, IAS 36.
Okay, next up, impairment under ISF 36. This is about making sure assets aren't sitting on the SFP at a value higher than what they're actually worth, or what can be recovered from them. What triggers an impairment test?
You need to look for indicators, both internal and external. External could be a big drop in the asset's market value, negative changes in technology or the economy. Internal indicators could be physical damage to the asset, obsolescence, or, really importantly, evidence that the asset's economic performance is worse than expected. Maybe it's generating operating losses.
And if you see an indicator, you perform the test. What is the test?
It's a simple comparison. Is the asset's carrying value, CV, its value on the SFP, greater than its recoverable amount? All right. If CVRA, you have an impairment loss.
Okay, so how do we figure out the recoverable amount?
The recoverable amount is the higher of 2 figures. You need to calculate both.
Which are?
Fair value less cost to sell, FELCS basically. What could you sell it for today, net of selling costs?
Yeah.
And value in use.
Yeah. And value in use involves a calculation.
Yes. VIU is company specific. It's the present value, PV, of the estimated future net cash flows the company expects to get from continuing to use the asset and from its eventual disposal. This requires forecasts and discounting.
Right, so you calculate both FELCS and VIU. Take the higher one as the RA and compare it to the CV. If CV is higher, you write the asset down. Where does that impairment loss go for a single asset?
The loss reduces the carrying value of the asset on the SFP, and the corresponding hit normally goes straight to profit or loss.
But there's an exception if the asset was previously revalued upwards.
Correct. If that specific asset has a balance sitting in the revaluation surplus from a previous revaluation gain, you must first use up that surplus to absorb the impairment loss. Only if the impairment loss is bigger than the available revaluation surplus does the excess amount hit PL. It maintains the logic of OCI.
Okay, that's for a single asset. Now, on the really complex part, impairment of a cash-generating unit, CGU. This needs a very specific allocation order.
Yes, this is mechanically challenging but crucial. A CGU is the smallest identifiable group of assets that generates cash inflows, mostly independent of other assets. Think of a specific factory or a retail store. When the entire CGU is impaired, its total CV is more than its total RA. You have to allocate that total impairment loss down to the individual assets within the CGU.
And there's a strict hierarchy for that allocation?
Absolutely mandatory three-step process.
Step one.
First, you allocate the loss to reduce the carrying amount of any specific assets within the CGU that are obviously damaged or impaired individually. Hit those first.
Okay. Step two.
Second, allocate the loss to reduce the carrying amount of any goodwill that has been allocated to that CGU. Goodwill is seen as the most fragile asset representing future potential, so it gets hit next. You write the goodwill down potentially to zero.
Right. And if there's still some impairment loss left after wiping out goodwill, step three.
Then that remaining loss is allocated across all the other assets in the CGU, the tangible and identifiable intangible ones, on a pro rata basis, based on their carrying amounts just before the impairment.
Can you quickly illustrate that pro rata bit?
Yeah.
Say $100 K loss left after hitting goodwill. Asset A has CV 300K, asset B has CV 700K.
Okay. Total CV of those remaining assets is $1 million, 300K plus 700K.
Yeah.
Asset A is 30% of that total, 300K $1. Asset B is 70%. So the 100K loss is allocated. 30K, 30% against asset A, and 70K, 70% against asset B.
But there's a floor, right? You can't impair an individual asset below certain amounts.
Correct. When doing that pro rata allocation in step 3, you cannot reduce the carrying amount of any individual asset below the highest of its own fair value, less cost to sell if measurable, its own value in use if measurable, and zero. You can't make an asset go negative, obviously, or impair it below its own recoverable amount if you can determine it.
Right. Let's tackle 3 areas notorious for being technically demanding and carrying significant calculation marks. We'll start with IFRS 16 leases from the lessee's perspective. Hashtag A leases, IFRS 16 lessee accounting.
IFRS 16 really shook things up, didn't it? Its main impact was bringing almost all leases onto the lessee's balance sheet. The old days of hiding lease commitments off balance sheet using operating leases, that's largely gone.
Why the change?
To improve faithful representation. If a company has control over using an asset for, say, 10 years via a lease and has an obligation to pay for it, that economic reality should be reflected on the SFP, an asset representing the right to use, and a liability representing the obligation to pay. It stops companies looking less geared than they really are.
But there are a couple of exceptions. Leases that can still be treated simply as an expense.
Yes, 2 practical exemptions. Leases where the total lease term is very short, 12 months or less, and leases where the underlying asset itself is of low value.
What's low value mean?
The guidance suggests thinking around US $5,000 or less when the asset is new. Things like tablets, small office furniture, maybe personal computers. For those short-term or low-value leases, the lessee can choose to just expense the lease payment straight line over the term. Much simpler.
But for everything else, any significant non-cancelable lease.
You have to recognize assets and liabilities.
Okay, how does the lessee measure these initially at the start of the lease?
At the commencement date, the lessee recognizes 2 things: a right of use, ROU asset, and a lease liability.
How's the liability calculated?
The lease liability is measured as the present value, PV, of all the future lease payments that haven't been paid yet. You have to discount those future payments back to today's value.
Using what discount rate?
Ideally, the rate implicit in the lease, the rate the lessor is effectively charging, but often the lessee doesn't know that rate. In that case, they use their own incremental borrowing rate, the rate they'd have to pay to borrow funds over a similar term with similar security to buy that asset.
Okay, so that's the liability. What about the ROU asset's initial cost?
It starts with the amount of the initial lease liability. Then you add any initial direct costs the lessee incurred, like
Yeah.
legal fees, add any lease payments made at or before the start date, and deduct any lease incentives received from the lessor.
Right, that's day one. It's quite a calculation. What about subsequent measurement? How do these balances change year on year? This involves two separate streams, doesn't it?
It does. This is the mechanical bit you need to nail. The ROU asset is treated much like other non-current assets. It gets depreciated, usually straight line over the shorter of the lease term or the asset's useful life, unless ownership transfers at the end, then use the useful life.
Okay, depreciation on the asset and the liability.
The lease liability is measured at amortized cost. This requires setting up an amortization schedule, just like for a loan.
Can you walk through how that schedule works for the first year or two? Students need to visualize this.
Sure, you start year one with the opening liability balance, the initial PV you calculated. First, you calculate the finance cost for the year. That's the opening liability balance multiplied by the discount rate you used. That finance cost hits PL.
Okay, interest expense.
Then, the lessee makes the annual cash payment required by the lease. That payment is split. Part of it covers the finance cost you just calculated. The rest of the payment reduces the principal amount of the liability.
So PIK minus finance cost, it yields principal repayment.
Exactly. You subtract that principal repayment from the opening balance to get the closing liability balance for year one. That closing balance then becomes the opening balance for year two, and you repeat the process. Calculate finance cost on the new opening balance, deduct principal repayment from the cash payment, find the new closing balance.
So the total expense hitting the PL each year for a lessee isn't the straight lease payment. It's the sum of the ROU depreciation, which is usually straight line, plus the finance cost on the liability, which typically decreases each year as the liability shrinks.
Precisely. The overall expense profile tends to be higher in the early years of the lease and lower the later years. This is very different from the old straight-line operating lease expense, and examiners love testing this difference.
Okay. Now, briefly, there's a more advanced bit. Sale and leaseback transactions. What's the key issue there?
The first question is, does the sale part actually qualify as a sale under the revenue recognition rules in IFRS 15? Assuming it is a genuine sale, control really transfers to the buyer lessor.
Then what does the seller lessee do?
The seller lessee has sold the asset but is immediately leasing it back. They need to recognize a ROU asset, but only representing the right of use they've retained through the leaseback. It's measured as a proportion of the asset's previous carrying amount.
And what about the gain on sale? Do they recognize the whole profit immediately?
No, and this is critical. They only recognize the portion of the gain that relates to the rights they've actually transferred to the buyer lessor. The portion of the gain that relates to the rights they've retained via the ROU asset is effectively deferred shade. It reduces the initial measurement of the ROU asset.
So it stops companies manufacturing artificial profits by selling an asset they're still basically controlling.
Exactly. It reflects the economic substance you haven't fully disposed of, the asset's benefits, if you're immediately leasing it back. Hashtag B. Provisions and contingencies. IAS 37, all right, IAS 37. Provisions, contingent liabilities, contingent assets. This is all about dealing with obligations where the timing or the amount is uncertain. The key is the recognition criteria for provision. It's quite strict.
3 hurdles to jump, right? Can you recap them?
Yep, all three must be met. 1, there must be a present obligation, legal or constructive because of a past event. The event that creates the obligation has already happened.
2.
2, it has to be probable that the company will have an outflow of economic benefits, like paying cash, to settle the obligation. Probable generally means more likely than not, so over 50% chance.
And 3.
3, you need to be able to make a reliable estimate of the amount of the obligation.
So if all 3 are met, present obligation, probable outflow, reliable estimate, you must recognize a provision liability on the SFP.
Yes, recognition is mandatory. Now, how you measure that provision can depend on the situation.
How so?
If it's a single one-off obligation, like a specific legal case against the company, you measure the provision at the best estimate of the expenditure needed to settle it. Basically, the single most likely outcome.
But what if it's not a single item, like warranty claims on thousands of products sold?
If it relates to a large population of similar items, IAS 37 says you should use the expected value method. You look at all the possible outcomes, assign probabilities to each, and calculate a weighted average. This gives a more statistically neutral estimate for the whole portfolio of obligations.
Okay. And what about time, if the settlement is years away?
If the effect of the time value of money is material, meaning discounting would make a significant difference, then the provision must be measured at its present value. You discount the estimated future outflow back to today's value.
And then what happens in later years?
Each year, you have to unwind that discount. As time passes, the present value gets closer to the future settlement amount. That unwinding of the discount is recognized as an additional finance cost in the PL each year. It gradually increases the provision liability on the SFP.
Right. Finally, IAS 37 also deals with things that aren't recognized as provisions. The contingencies. How do they differ?
Okay, a contingent liability. This is either a possible obligation, less than 50% chance of outflow, or it's a present obligation, but you can't estimate it reliably, or the outflow isn't probable.
And what do you do with a contingent liability?
You don't recognize it on the SFP, you just disclose it in the notes to the financial statements, unless the possibility of outflow is remote.
Okay, and the flip side, contingent assets.
A contingent asset is a possible asset arising from past events, whose existence depends on future events, not wholly within the company's control. Think maybe a potential insurance claim payout.
How are these treated?
Because of prudence, we're much more cautious with potential gains. You only disclose a contingent asset in the notes if the inflow of economic benefits is considered probable. You only actually recognize the asset on the SFP if the inflow becomes virtually certain.
So a much higher hurdle for recognizing assets than liabilities.
Definitely. That asymmetry, recognize probable liabilities, but only recognize virtually certain assets, is a cornerstone of prudent accounting. #C. Income taxes, IAS 12. The deferred tax calculation.
Okay, the big one for many students. Deferred tax under IAS 12. It often seems incredibly complex, but maybe the key is understanding the basic conflict it's trying to resolve.
That's exactly it. At its heart, deferred tax exists because accounting profit, calculated using IFRS rules, is very rarely the same as taxable profit, calculated using the tax authority's rules.
And why are they different?
Mainly because of temporary differences. These happen when the rules for recognizing income or expenses, or the carrying value of assets and liabilities, differ between accounting standards and tax law.
The classic example being depreciation for accounting versus tax allowances, capital allowances.
That's the most common one by far. Accounting might depreciate an asset over 10 years straight line. Tax rules might give accelerated allowances over, say, 5 years. This timing difference creates a temporary difference. Deferred tax tries to account for the future tax consequences of these differences today.
Okay, so conceptually, it's about matching tax effects to accounting periods. Let's get into the mechanics. How do we actually calculate it? Step 1.
Step 1 is to calculate the temporary difference, TD, itself for each relevant asset or liability. The formula is usually assets carrying value, CV, on the SFP minus the asset's tax base, PB.
What is the tax base?
The tax base is essentially the amount that will be deductible for tax purposes in the future relating to that asset. For PPE, it's often the original cost minus the cumulative tax allowances claimed so far.
Okay, CV minus TB gives the temporary difference. Step 2. Is it a liability or an asset? This is the key logic point.
Right. Think about it. If the carrying value is greater than the tax base, CVTB, what does that mean? It means the accounting value is higher. The remaining future accounting depreciation will be more than the remaining future tax allowances. So, in the future, accounting profit will be lower than taxable profit. You'll pay more tax in the future because of this difference. That creates a deferred tax liability today.
Makes sense. And the opposite, if CVTB, maybe due to very fast tax allowances.
If CVTB, it means the remaining future tax allowances will be greater than the remaining accounting depreciation. You get more tax relief in the future than accounting expense. So you'll pay less tax in the future because of this difference. That creates a deferred tax asset today, though there are recoverability tests for recognizing DTAs.
Okay, so we've identified the TD and whether it's creating a future liability or asset. Steps 3 and 4 are the maths.
Pretty much. Okay. Step 3. Take that closing temporary difference amount and multiply it by the tax rate that's expected to apply when the difference reverses in the future. That gives you the required closing deferred tax balance, liability or asset, that needs to be on the SFP at the end of the year.
And step 4, the PL impact.
Step 4. The charge or credit that goes into the PL for deferred tax is simply the movement in the deferred tax balance during the year. So closing balance from step 3 minus the opening balance from last year's SFP, that movement is your PL figure.
Okay, that's the standard process. But there's a crucial interaction with IAS 16 revaluations. What happens to the deferred tax if an asset is revalued upwards? That increases its CV, right? So it creates or increases a deferred tax liability. Where does the debit entry for that specific bit of deferred tax go, not PL?
No. And this tests your understanding of matching and OCI.
Mm.
Since the original revaluation gain itself went directly to other comprehensive income, OCI, and the revaluation surplus, the deferred tax impact arising from that revaluation must also be recognized in OCI. To match like with like. If the gain bypassed PL, the related tax effect must also bypass PL. If you put the tax charge through PL while the gain went to OCI, you distort the reported operating profit. So revaluation gain to OCI, related deferred tax charge also to OCI, #tag revenue recognition, IFRS 15, and financial instruments.
Okay, final stretch. Let's look at the top line revenue under IFRS 15 and then dip into the complexities of financial instruments under IFRS 9. IFRS 15 was a big change, wasn't it? Moving away from risks and rewards.
Huge change. It introduced a single principles-based 5-step model focused on when control of a good or service transfers to the customer. #hedge A, the 5-step model, IFRS 15. This model requires judgment at each stage. Let's quickly list the steps.
Go ahead.
1. Identify the contract with the customer. Needs things like approval, commercial substance, probable collection. 2. Identify the separate performance obligations, POs, in the contract, the distinct promises made. 3. Determine a transaction price, how much you expect to get. 4. Allocate that price to the different POs based on their standalone selling prices. 5. Recognize revenue when, or as, you satisfy each PO by transferring control.
Okay, step 3. The transaction price can get complicated, especially with variable consideration. What's that?
Variable consideration is anything that can make the final price change: performance bonuses, discounts, rebates, refunds, penalties. The company has to estimate the amount it truly expects to be entitled to.
How do they estimate that?
2 methods allowed. The expected value method, probability weighting all possible outcomes, good if there's a wide range, or the most likely amount method if there are really only 2 possible outcomes. Very G, get the bonus or don't.
But you can't just recognize all of that estimated variable amount straight away, can you? There's a constraint.
A very important one. You can only include estimated variable consideration in the transaction price, up to the amount where it's highly probable that a significant reversal of the cumulative revenue recognized won't happen later when the uncertainty clears up.
So it stops companies booking uncertain income too early.
Exactly. It's a safeguard against overly optimistic revenue recognition. You have to be pretty confident you'll keep it.
Okay. Then step 5, recognizing revenue when the PO is satisfied. This can happen at a point in time or over time, right? Like for construction contracts.
Yes. If control transfers over time, you recognize revenue based on your progress towards completing that PO. How do you measure progress? 2 main ways.
Which are?
The output method, looking at the value transferred to the customer so far. Think things like surveys of work performed, milestones reached, units delivered, or the input method, looking at the effort or costs you've put in relative to the total expected inputs, like costs incurred as a percentage of total expected costs. The method chosen has to genuinely reflect how the company is transferring control.
And the result of this revenue recognition process feeds directly into the balance sheet, creating contract assets or contract liabilities.
Absolutely essential link. The balance is simply revenue recognized to date minus amounts invoiced or billed to date.
So if you've done the work and recognized revenue but haven't billed the client yet?
You have a contract asset. It's your right to get paid, conditional on something other than just time passing, like finishing the next milestone.
And if you've billed the client up front or collected cash before you've done the work and earned the revenue?
Then you have a contract liability, often called deferred revenue or income received in advance. It's your obligation to deliver the goods or services later.
Okay. One final massive trap in IFRS 15, deciding if you're acting as a principal or an agent. This hugely impacts the revenue number reported.
Huge impact. And the decision hinges entirely on control. Who controls the specific good or service before it gets transferred to the end customer?
So if the company controls it, maybe holds inventory risk.
Then they are the principal. They're satisfying the PO themselves. They should recognize revenue on a gross basis, the full amount paid by the customer.
And if they don't control it, maybe they're just arranging a sale for someone else.
Then they're acting as an agent. They never controlled the underlying good or service. Their performance obligation is just to arrange the transaction. In that case, they only recognize their commission or fee as revenue, the net amount they retain. Making the wrong call here drastically misstates the scale of the business shown in the revenue line. #tag B, financial instruments, IFRS 9. Okay, briefly onto financial instruments under IFRS 9. Classification here is key, and it depends on 2 things. the company's business model for managing the assets, and the cash flow characteristics of the instrument itself.
Let's start with simple equity instruments, shares in other companies. What's the default treatment?
The default is fair value through profit or loss, FVTPL. Any cost to buy the shares, transaction costs, are expensed immediately. Then, every reporting date, you remeasure the shares to fair value and the gain or loss hits PL.
But there's an option.
Yes. If the shares are not held for trading, may be held for long-term strategic reasons, the company can make an irrevocable choice when they first buy them to classify them as fair value through other comprehensive income, FVTOCI.
And if they choose FVTOCI?
And then the transaction costs are capitalized as part of the assets cost. Subsequent fair value changes go to OCI, not PL. And importantly, when you eventually sell these FVTOCI equity shares, the cumulative gain or loss in OCI is never recycled to PL. It usually gets transferred straight to retained earnings.
Okay, that's equities. What about debt instruments, things like loans or bonds? When can they be measured simply at amortized cost?
Amortized cost is allowed only if the instrument passes both of two tests.
Just one.
The business model test. Is the company's objective for holding this asset simply to collect the contractual cash flows, the interest and principal, not to sell it for short-term profit?
And test two.
The contractual cash flow test, often called the SPPI test. Do the contractual terms of the debt give rise only to payments of principal and interest on that principal, on specified dates, solely payments of principal and interest? What if it fails SPPI? Say, the interest payments are linked to the borrower's profit, not just a standard interest rate.
If it fails either the business model test or the SGPI test, it cannot be measured at amortized cost. It usually has to be measured at fair value, most likely through PL, FVTPL. This ensures instruments with more complex or variable cash flows get marked to market, providing more relevant info.
Okay, final complex bit here. Convertible debentures or convertible loans. These have both debt and equity features. How do we account for them? Requires split accounting.
Yes, IS 32 demands we reflect the economic substance. A convertible bond gives the holder the option to convert it into shares. That option has value. So when the bond is first issued, we have to split the proceeds received into two components, a liability component and an equity component.
How do we calculate the liability part? The liability component is always calculated first. You take all the future cash flows specified in the bond contract, the regular coupon interest payments, plus the final principal repayment, assuming no conversion happens, and you discount those cash flows back to present value.
Using what discount rate? The bond's coupon rate?
No, crucially, you use the market interest rate that would apply to similar debt issued by that company without the conversion option. This rate will always be higher than the convertible's coupon rate because normal bondholders would demand a higher return if they weren't getting the potentially valuable conversion feature.
Right, so discount the cash flows using the higher pure debt market rate. That gives the initial liability value. And the equity component
Is simply the residual. It's the total cash proceeds received from issuing the bond minus the initial liability value you just calculated. That plug figure represents the value of the conversion option granted.
And how are these treated later?
The liability component is then accounted for at amortized cost using that effective market interest rate, leading to an interest expense higher than the cash coupon paid. The equity component just sits there, in equity, unchanged, until the bond either matures or is converted into shares. #, investor analysis quick ratios. And wrapping this all together, all these accounting numbers, the profit, the assets, the equity, they feed directly into how investors analyze the company. You need to be able to calculate and briefly interpret the key ratios.
Especially the ones focused on profitability and shareholder value.
Exactly. Things like basic earnings per share, EPS, how much profit belongs to each ordinary share, ratios about paying dividends, like dividend cover, how many times could the year's profit cover the dividend paid, and dividend yield, the dividend per share, as a percentage of the market price.
And valuation metrics.
The big one is the price earnings, PE ratio. That's the market price per share divided by the basic EPS. It gives you a sense of how much the market is willing to pay for each dollar of current earnings.
What does a high or low PE suggest?
Generally, a high PE suggests the market has high expectations for future earnings growth. A low PE might suggest lower growth prospects, or maybe the market thinks the company is undervalued or perhaps riskier. Being able to briefly comment on how a major accounting adjustment, like a big impairment write-down or a change in lease accounting, might impact these key ratios is often tested in discussion parts, #outrotro. So we've really dug into the conceptual framework, understanding that foundation. We've navigated the details of PPE, R&D capitalization, CGU impairments. We've tackled the mechanics of IFRS 16 leases and the logic behind provisions and that often feared deferred tax.
Yeah, getting a solid grip on these areas, really understanding the why behind the mechanics, is absolutely crucial for doing well in the FIR exam.
It really is non-negotiable.
This has been a pretty intense session, but hopefully really valuable, designed to build your confidence in applying these standards in exam conditions. Remember, it's about application and integration, not just reciting rules.
And just to remind you, this deep dive is part of our ongoing SmartPass series. Our upcoming episodes will keep exploring financial reporting in depth. Next up, we're tackling arguably the biggest single topic area,
Which is?
group accounts. We'll be diving into consolidations and associates, getting into the workings for goodwill, non-controlling interest, group retained earnings, all that complex but vital stuff.
Definitely a session not to miss if you're preparing for FR. To make sure you've got everything you need to study smarter and pass with confidence, do check the video description. There are links there to other SmartPass study resources.
And subscribe to the SmartPass YouTube channel. That way you'll get notified about future episodes as soon as they drop.
Okay, before we sign off, here's that final thought to mull over, linking back to the new ISSB standards we mentioned earlier.
We talked about how high measurement uncertainty can undermine faithful representation. Now, IFRS S1 and S2 are pushing companies to integrate potentially very uncertain long-term climate risks, like assets becoming obsolete due to regulation or physical climate impacts into financial estimates. So the question is, how can companies effectively use the concept of prudence when building the valuation models, like value and use calculations, that have to incorporate these incredibly subjective, long-range climate forecasts? Where's the balance between prudence and reliable estimation going to fall?
That's a really interesting challenge, isn't it? The intersection of climate risk and traditional financial valuation. Definitely something for the future of reporting. Thank you so much for joining us for this deep dive.
Good luck with your studies.
And we'll catch you on the next episode.